Good evening. Good evening. Let's start. Am I visible? Screen दिख रहा है, मैं दिख रहा हूँ. Good evening, यशोदन, विश्वजीत, ऋषिराज, आकाश. Me and screen are both of us visible? Okay. Let's start then. So let's start. So we are at last part of the chapter, applications of time value of money. We have already seen leasing. Leasing is what? जब आपके पास दो ऑप्शंस होते हैं, when you have two options, one is to purchase the asset, one is to take the asset on rent. So what we do is purchase the asset means paying today, and taking the asset on rent means paying over multiple years. So we use annuity, present value of annuity, to compare both. Like I said, these kind of questions will generally not come in your exam because they are at inter and final level, but some basic level questions might come. Good evening. Fine. So let's see next, capital expenditure decisions, which is also called as calculation of NPV. I mean, it involves calculation of NPV, which we have already seen. Let's see an example of that. Suppose you have an option to invest in a project worth rupees 10 lakhs. You have to invest today, obviously today. And your expected returns from the project are maybe at year one, that is at the end of year one, you are expecting rupees 3 lakhs. At the end of year 2, you are expecting rupees 5 lakhs. At the end of year 3, you are expecting rupees 5 lakhs. And hello, yes. And I think the comments are a bit behind here, as usual. Fine. And let's say your interest rate expected is 9%. Question is, should you invest? So let's say capital expenditure is बहुत बड़ा expense है. The project is huge. So how should you decide whether you should invest or not? Take some time and find by yourself first. I'll wait for 2 minutes. We have already seen this concept. You are investing 10 lakhs today at year 0. You are going to get, this is negative because you are paying it. Then year 1, 2 and 3, you are going to receive rupees 3 lakhs, 5 lakhs, 5 lakhs. So maybe try to bring everything to present at 9% and check whether you should invest or not. Let's see if anyone gets the answer. I'll wait for a minute or two. Anyone? अब तक आना चाहिए था. You should have got the answer till now. Fast. Speed is very important. Should I explain? See, this 10 lakhs is today, so we have to bring 3 lakhs also to present, 5 lakhs also to present, and this 5 lakhs also to present. How do we present this? Rishuraj, you want me to repeat the question? If anyone has not understood the question, let me repeat it. You have to invest this today, and you are going to receive this over 3 years. You are expecting 9% return. Should you invest? That is what you have to find out, Rishuraj. So 10 lakhs is today's payment, and 3 lakhs, 5 lakhs, 5 lakhs are receipts over 3 years. So let's discount them. How do we discount? Divided by 1 plus I raised to n. So let's take 3 lakh behind by 1 year. So divide by 1.09. That gives us 275,229. We will invest Yashodhan. Okay, good. Let's check. 5 lakhs will divide by 1.09 square. So that is 420,839. Fine. Or 840. And this 5 lakhs will divide by 1.09. Q, because that is we have to take it behind by 3 years, take it back by 3 years. That is 386092. So total of receipts is how much? Let me take total of receipts 275,229 plus 428,40 plus 386,092. That is 10,82,161. Very good, Yashodhan, that is correct. That means we will invest. Why? Because we have to pay 10 lakhs, whereas we are getting 10,82,000. So that is good, right? So we are getting more than 9% return. We'll invest. This is called as the difference. 82,161 is called as NPV, if you remember. We should invest. Correct. Good. Let me know if everyone has got this. NPV is 82,161. Fine. That is called as capital expenditure decision. That is whether we should invest in a big project or not. How much are the returns going to be? This also you have to see in much detail at inter and final level. Kyun dekho, why? Because at inter and final level, this will also involve tax. This will also involve depreciation. This will also involve scrap value of the asset. This will also involve tax on sale of asset. So there are going to be a lot of issues coming in this, but in inter and final level. Right now you just have to understand the concept that you can bring everything to one point, generally present, so that you can find its NPV to analyze whether we should invest or not. Is it clear to everyone? Is this clear? Let me know. We have covered leasing yesterday. This is capital expenditure decision. Next point is bond valuation. Now this is even more advanced. This is something that is going to come up in CA final directly. But still, let me just explain in short. Bond valuation is what? Bond is a debenture. Clear? Good. Bond means, let's say debenture. You have invested in debenture of a company. Or you want to invest in debenture of company. Okay, you want to invest in a 100 rupee debenture, or let's say 1000 rupee debenture with, let's say, 10% coupon rate. Coupon means interest on that debenture. Okay, coupon rate means what? What debenture pay on that debenture you are going to get 10% interest every year. Because debenture is like loan. Debenture is what? When company takes a loan from general public, that is in the form of debentures. So let's say you want to invest in a debenture of 1000 rupees whose coupon rate is 10%, and it is maturing. Obviously it is loan. That means after some time company will repay that loan to you. Company, right now you will give the company your money. After some time the company will give you back the money, because that is like a loan, right? So it is maturing. It is maturing in 5 years. So you want to invest in this bond, that is debenture, which is maturing in 5 years and which is going to pay you 10% interest per annum. Now your expected rate is 12%. Debenture to 10% interest there. Debenture is giving you 10% interest, but you want 12% interest. You want 12% interest. Obviously, you want 12% interest. Is the debenture giving you 12% interest? Tell me. No, debenture is giving you only 10% interest. Iska matlab, that means you will not be ready to purchase the debenture at 1000 rupees. You will be ready to purchase the debenture at something below 1000 rupees, right? Why? Because the debenture is not giving you as much as you want. So you will not be ready to purchase the debenture at 1000. You will say that I want 12% return. Debenture is giving me 10% return. Why should I pay 1000 rupees? I will pay some less amount. Okay. So we have to find how much will you pay for the debenture. How much will you pay for the debenture? How much will you pay for the debenture? Let me know if everyone has understood the question. Question is clear to everyone? If yes, let's see how to solve this now. Consider it carefully now. The debenture is of 1000 rupees, and it is going to give you 10% coupon per annum for 5 years. That means, okay, now is it visible? Tell me everyone. Is it visible now? Okay, I think now it will be visible. Fine. Tell me, are you able to see the screen also? Good. Fine. So I guess the screen is also visible now. I am also visible, so I'll continue. If it still lags, let me know. Okay, because I have connected from mobile hotspot. There are chances that it will lag. If it does, let me know. Fine. So my point was, this debenture is of 1000 rupees, which is going to pay you 10% per annum coupon, right? That means for next 5 years it will pay you 10%, 100 every year, and at the end of 5th year the company will also repay your 1000 rupees, because that is like your principal which you gave them, right? You gave 1000 rupees loan to them, they paid interest 10%, 10%, 10% for 5 years, and then they repaid your 1000 rupees. Okay, now let's find out its present value. Obviously you can see, if you can understand this, that this will be the amount that will be ready to pay. Whatever present value we find for 100, 5 years and 1000, that will be the amount that you are ready to pay. Discounting कौन सा rate पे करना है? At what rate should we discount? 12%, because we want return of 12%, right? So let's discount everything at 12%. Now consider very carefully that 100, we don't have to like take it, discount it separately, because that is an annuity. We can use present value of annuity regular for 100 rupees, and let's find factor with 12% for 5 years. Try to find present value of that annuity. 1 divided by 1.12, 5 times equal to grand total into 100, that is 360.47 or 48. 360.48 plus this 1000 rupees present value we have to take. So let's discount that 1000 rupees separately. Now this is only one time payment, so let's just divide it by 1.12 raised to 5. That's all. That is a 1.1 time payment, right? So 1000 divided by 1.12, 5 times equal to, that should give you 567.43. so total is how much? Check. 360.48 plus that 927.91 around. This is the amount that will be ready to pay. The bond's face value is 1000 rupees. Face value of that debenture is 1000, but you will not be ready to pay 1000. You will be ready to pay only 927, because the bond gives 10% return, whereas you want 12% return. That is why you will not be ready to pay 1000 rupees. Tell me, is this clear? This was in simplest terms. This is something that you have to study in very much detail when you go to CA final. 303 Rishuraj, वापस. Rishuraj, वापस, try again. That is annuity. The factor comes to be 1 divided by 1.12, 5 times equal to grand total, which is 3.60477 something. Then into 100 is 360.48. Check. Fine. Is this clear to everyone? Any doubt? Also just let me know it is not lagging now, right? The video is clear. If yes, let's go to next concept. Bond valuation. Next concept is real and nominal interest rate, and then something called as CAGR. Real and nominal interest rate. Understand what it is. There are no calculations involved right now for us. Let's see what are real and nominal interest rates. Good. Concentrate. Let's say you go to bank, you deposit 1000 rupees at 10% for 1 year. Generally, currently 10% rate is not given by the bank. Okay, generally FD rates are 7%, 6%. But let's assume that you are getting 10% for 1 year. Okay. That means after for 1 year, how much interest will you get? You will get 100 rupees interest, right? And after 1 year, you will get 1100 rupees. But understand very carefully, you have got 100 rupees. That does not actually mean that you have earned 100 rupees. Okay, you have received 100 rupees, that is okay. But that does not mean you have earned 100 rupees. Why? Because during the year, tell me, during the year, the things which we could purchase, the things which we could purchase for 1000 rupees, will their price remain same after 1 year? Or will that generally increase due to inflation? Right? Due to inflation, there is general price rise in the economy, right? So whatever you could purchase for 1000, now you will be able to purchase it maybe for 1050 rupees, 1060 rupees or something like that, right? So there is some impact of inflation also which we have not considered here. What is that impact of inflation? Consider it. Let's say inflation in the country during the year was maybe 8%. Let's say inflation in the country during the year was 8%. That means increase in prices due to inflation is 8% and you have got 10%. That means you have actually got 2% only extra. If we remove the effect of inflation, you have only got 2% extra, understand? If we consider that prices increased by 8% and you got interest of 10%, that means actually you got only 2% extra. So that inflation impact, if we remove, then that is called as real interest rate. This 10% is called as nominal interest rate. So when from nominal interest rate, we subtract impact of inflation, then what we get is called as real interest rate. Again, this concept is going to be there in detail when you go to CA final. Right now they have just given you introduction, that understand real interest rate means nominal minus inflation. That is your real earning, actual earning. We have seen this real concept, real value concept in some other chapter also. Can anyone tell me which chapter? Which other chapter? We have seen this real income concept in some other chapter also. Can anyone tell me which one? If anyone remembers. No one? No one. Have we seen something called as real GDP, real wages in the chapter of index numbers? Right. In index numbers, we use this concept to deflate a time series. To deflate a time series, we use this concept in index numbers chapter. I hope you've studied that. That is again an important and very easy chapter. So from scoring point of view. Next, last concept of the chapter is CAGR. Let's see what is CAGR. CAGR is compounded annually average growth rate. Compounded annual or average growth rate. How do we find CAGR? Let's say, and what is CAGR? Let's say you have been given year 1, 2, 3, 4, 5 and profits. Let's say profits are 150, let's say that is rupees in lakhs, 150, 180, 220, 225 and 250. Then compounded annual growth rate means average growth rate during the period. Average growth rate during the period. Now can anyone tell me, if we want growth rate, average of growth rate, then I am still visible, right? Fine. If we want average of growth rate, then which average should we take? Let's see how many of you remember statistics. If we want average of growth rate, which average should we take? Which average should be used for calculating growth rates, for averaging growth rates? Anyone? Any idea? We do not use arithmetic mean for this because growth rates are dependent on previous rate, right? We say that they are exponential. So we don't use arithmetic mean. We use geometric mean for this. Okay. Correct. GM, good, Misbah. We can use GM for this. So we can solve this using GM also, but I'll show you how to solve this using GM, but we can solve this using CAGR also. I mean time value of money also. How to solve that? Simple. Understand. The formula which they have given in module, I think, let me check. That is, I mean, don't see that formula. This formula that they have given in the module, this. Forget about that formula. Let's simplify that formula. In simple terms, what you should do is assume first year's amount as principal. Assume last year's amount as amount. Find out number of years in between year 1 and year 5. There are 4 years between. So let's take n as 4. And let's try to calculate I using compound interest formula. We know that under compound interest A is equal to P into 1 plus I raised to n. That means 250 is equal to 150 into 1 plus I raised to 4. What is 250 by 150? 1.6666 is equal to 1 plus I raised to 4. Let's raise both sides by 1 by 4. So 1.6 recurring raised to 1 by 4 is equal to 1 plus I. For 1 by 4 we do not need 12 times root. We can just take 2 times square root because it is half into half. So take 2 times square root of 1.666666. That gives us 1 plus I equal to 1.1362. So I will be 0.1362, which is 13.62%. Check if everyone has understood this. That is called as our compounded annual growth rate. Compounded annual growth rate is 13.62%. This is what you have to use. This is what you are going to use in exam. In exam, you have to take first year as principal, last year as amount, and use compound interest formula, nothing else. Fine. Don't refer to the formula given in module, that is complicated to understand. Use this is better. There's one more way to find this out. We can also take geometric mean. We will not use this, but understand how to do it. Understand. Don't use it, but understand. We can use geometric mean, last concept of the chapter. Let's find annual growth rates. We have to take average growth rate, right? So let's find annual growth rate first. From 150 to 180, profit has increased by how much? It has increased by 30, right? So on percentage basis, it has increased by 30 over 150. From 150, it increased by 30. So how much percent? 30 by 150 is 20%. 20%. Then from 180, it increased by 40, I think. 40, correct? 40 over what? 180. 180 was the base. Okay, it is raining too much here. 40 by 180 is how much percent? 22.2 recurring percent. Calculate for all. Here it has grown by 5 over 220. So 5 by 220 is 2.27 recurring percent. And here it has grown by 25. So 25 over 225 is 11.1 recurring percent. So those are the growth rates. What are the growth rates that we have got? 20%, 22.22%, 2.27 recurring percent and 11.1 recurring percent. Now we have to take their geometric mean. How do we take geometric mean? Now we don't multiply them directly. Let's add 1 to everyone. This is 20%, that means 0.2. So 1 plus I will be 1.2. Here it will be 1.222. Here it will be 1.0227 recurring. Here it will be 1.1111 recurring. And let's take geometric mean of this. Geometric mean means what? We have to raise it by 1 by 4. Take product 1.2 into 1.2222 into 1.0227272727 into 1.11111. That gives you 1.6 recurring raised to 1 by 4. Same answer as above. Here also we are getting 1.6 recurring raised to 1 by 4. Right? So answer will be 13 point. That will be 1.1362, which is 1 plus I. So I will be 13.62%. But do not follow this. Obviously, do not follow this. In exam, we simply have to do first year as principal, last year as amount, how many years in between, 4 years, and compound interest formula. That's all. Nothing else. That is called as CAGR. Fine. So finally we are done with the chapter. If anyone has any doubt, you can let me know. Otherwise, we'll stop, and from tomorrow we'll continue with statistics. First, we'll go to statistical description of data. Then we will go to central tendency and dispersion. Statistical description will take 1 day. From day after tomorrow, we'll start with central tendency dispersion. Understand, statistical description जो chapter है, that is entirely theory, but again very important for scoring because very easy. So anyone has any doubt? Understood? Good. Start value and end value, that means principal and Yashodan, same. Principal and amount, right? Don't look at this formula, that will be confusing. Just take start value as principal, end value as amount, and solve it. No issues. So if there is no other doubt, let's stop for today. We'll meet tomorrow at same time. Okay? Good. Okay then. Bye everyone. We'll meet tomorrow. Okay, good night. Chalo, bye. Yes, no doubt. Good. I think I'm a bit behind in comments. Fine. Okay then, chalo, bye. Good night. Yes, all clear. Good. Tomorrow with statistics. Good night.